All right, how's it everyone? I hope you guys had a fantastic weekend and that you're ready to get stuck into another week ahead. Now, in terms of the calendar, guys, it's a very light one on the US side. We have very little US data to get excited about this week. We do have a couple of other ones on the radar. Some of them could be interesting. Some of them pretty much a nothing burger, I would expect. I mean, we have things like Canadian inflation data coming up. We have UK jobs and inflation data as well, Aussie jobs data, flash PMI data. But to be fair, I'm not expecting major fireworks from any of these in the week ahead. But let's take a look at some of these in a bit more detail. Let's start with the first major one coming up, which is Monday's Canadian CPI data. Now, in terms of CPI data, looking at central bank expectations, the markets aren't expecting any near-term change from the BOC. We can see that there's practically nothing priced in for the September meeting, about 6 basis points priced in by October, and then there's about half a hike priced in by the end of the year. So that means if the inflation data comes out with a whopper of a surprise this week, either up or down, I suppose that could swing the pendulum for the year-end pricing a little bit. If it's obviously very bad data, that could see the market starting to price in a higher probability of a no change. If it's very good data, it could start seeing pricing in a higher probability of potentially one hike. But again, at 14 basis points, it would need to be a really big surprise to really get the markets going. So personally for me, I'm not sure whether this one will be worth, I don't know whether this one's juice will be worth the squeeze, basically. Apart from CPI, another thing to keep in mind, arguably, is that the bigger focus for CAD traders this week will be the trade agreement deadline between the US and Canada. I think that deadline is coming up on Wednesday, and that deadline is basically there for them to try and reach an agreement for Canada to try and avoid the new 50% tariffs on about 20 or 30 billion worth of Canadian exports to the US. So any failure or success of a deal, or let's just say failure and success of an extension, that could be a bigger mover for the Canadian dollar compared to just the CPI data. So personally, not expecting a lot from that CPI data. In terms of expectations from the markets, let me just show you guys here. The headline is expected to be volatile, as you would expect. Sorry guys, let me just grab Canada here for a second. There we go. So there we go. So headline is expected to be volatile, as you would expect. Some are expecting the headline year over year to actually print above 3%. So there's been a couple of houses calling for something closer to 3 and 3.1%. However, the thing to keep in mind about inflation data is that the bank has told us a few times now that they are more than willing to look through any type of short-term energy-driven inflation volatility. So whether this thing prints 2.7 or whether it prints 3.1, I don't think the market really cares about that. As always, the main focus when it comes to Canadian CPI data will be on these three, right? The CPI median, the CPI trim, and the average of these two, that is the BOC's preferred measure of core inflation. Now, don't try to look for this one in a regular calendar. This is one that I've built, so you won't see this data point anywhere. But if you want to, gauge this by yourself, it's literally just the average between that CPI median and the CPI trim. That is where the main focus will be. Now, in terms of those ones, look, they've been steadily falling for the last couple of months now. If you take a look at the trend, the last couple of years, to be fair, after that obviously massive spike we had back in 2022, we've been on a very steady path to the downside for this one. And both of these two prints are now sitting below that 2% mark, basically right at the bank's target. So unless we see these numbers come in with massive surprises, I just don't see the bank having to do anything at this stage, and hence the markets won't want to do anything with the Canadian dollar purely based on that as well. Now, because the US calendar is very light, I suppose dollar CAD, if you had to trade something, I suppose dollar CAD would probably be the one to look for a possible trade this week. From a technical point of view, we had that huge run to the upside a couple of weeks ago, big break above the 200. We reached all the way up to that 142.50 level, and now we've basically given back half of that initial run to the upside. We're sitting around that 138.70 mark, just above the 200-day moving average. So if Canadian CPI data comes in massively hot, right? If we were to see that core number the average of the two cores, if we were to see that printing above something like 2.1%, let's just say it's 2.1 or 2.2%, and we get a deal between the US and Canada, for example, if we can see those two things materialize, it could be enough for the market to start pushing to the downside here. Maybe it's enough to see a break and close below the 200-day moving average, which will put a move back down towards that 137.30 on the market's radar. And apart from that, if we see CPI continue to decelerate, so for example, if we see the core measures printing below, let's say, at 1.7 or lower than that, and we see the failure of any type of deal or even the failure of an extension, if tariffs get slapped on Canada, then we could potentially see the markets using this test of the 200-day as a possible bounce area. Levels there to watch to the upside would be 139.50, which is that prior level of resistance, and then above that could be a move back up towards 141 as well. Again, not expecting any fireworks from this, but it's definitely one just worth keeping on the radar. Now, apart from that, in terms of the UK, we have two batches of data we need to worry about. On Tuesday, we have the jobs data. Where's pound? Here we go. We have the jobs data, and then on Wednesday, we've got CPI. Now, you're going to want to trade or take a look at both of these in the aggregate, right? We don't just want to focus on the jobs and the inflation. Both of these needs to be seen together. For me, these two are probably the most interesting data points apart from Aussie jobs data that we have coming up this week. As usual, we have the jobs data first on Tuesday. That's followed up by the CPI data on Wednesday. Now, between the two, CPI data will, as usual, be more important for obvious reasons, given the inflation concerns, but also because there is still a lot of quality issues with the employment data from the ONS in the UK. So just keep that in mind. Now, I think the market's main question for this week's UK data will be whether the labor market and obviously wage data and inflation is cooling enough for the bank to stay put on rates. Because remember, despite the fact that the labor market has shown a lot of loss of momentum, the markets are still very comfortable with fully pricing in one more hike by the end of the year for this bank. Now, I've said for a while now, for the past, ever since the market flipped from expecting cuts to expecting hikes, for me, this just didn't make any sense, right? The UK economy is they're not in a spot to be able to afford hikes at this stage. The only reason why this has been priced in was mainly due to the inflation story. Because, like I said, labor has been showing signs of a loss of momentum for a while now. So that means the main focus when it comes to the jobs data itself on Tuesday won't necessarily be the jobs data. It'll be the wage data, right? Because remember, there's a lot of quality issues when it comes to the jobs data itself, even the unemployment rate to some degree. So wage data will be a key focus point, and then obviously that'll feed into how the markets trade, or that'll just feed into any type of beat or miss that we see for that CPI data coming up the day after. Now, in terms of expectations, it's pretty messy. Consensus is seeing, when it comes to CPI at least, consensus sees a push to the upside for the headline number. Some is calling for that to be close to or just above 3%. But that is partly driven or mostly driven by energy again, with the Ofgem energy cap also expected to be raised as well. So the market's already expecting headline to show signs of upside, but at the same time, those core measures, core year over year is expected to slow, and services year over year is expected to slow. So I would expect the markets to be able to discount whatever happens to the headline number, right? If headline comes in much hotter or much lower than expected, I would expect the markets to look through that fairly easily, because the assumption would go like this. If it comes in weaker than expected, their assumption would be, okay, cool, the pass-through from the energy cap is lower than what we expected. If it comes in higher, then they'll be like, okay, cool, the pass-through for the energy cap has been higher than what we expected. But as long as it doesn't impact core, the headline number just shouldn't matter this week. I think the markets will be able to look through that fairly easily. The main focus will be core year over year and services year over year. Those two are the critical ones we need to watch. Now, in terms of tradability, look, I think the best case scenario we can hope for is for both of these two things, i.e. the jobs report and the CPI print, to show us the same directionality, right? If you have a really hot jobs numbers or hot wage numbers, you want to see inflation coming in hot as well, to give you the best chance of success for trading the pound to the upside. Or if the data comes in really bad for the jobs data, you want it to be really low on the inflation side, again, to give you the best bang for your buck. Now, between these two, let's start with a possible miss. If we get really weak job and wage numbers and very soft inflation data, that would be the clearest dovish combination. That should also be enough for the markets to potentially start pricing out that fully priced in hike by the end of the year, right? That could see some pushback in those expectations, pushing back against the idea of a hike, especially if we can see soft wages as well as some soft employment data. Again, I don't think we need soft employment data as long as wages falls. But obviously, if we can get just a bad print across the board, lower wages, higher unemployment, softer inflation, that would be the ideal environment to expect some softness for the pound. Now, in terms of assets to look for, I think pound Aussie and pound Kiwi is probably the two that I would be focused on the most for a bearish scenario. I still like the Kiwi to the upside, even though it hasn't performed as well as I would have liked over the course of the last few weeks. It is still one of the only central banks that the markets are very aggressively priced for at the moment for hikes, right? If you take a look at the curve across the board, you can see that the RBNZ is the one that is expected to hike the most this year. I would still expect that to translate into some strength for the Kiwi. And if we can see UK data coming in much weaker than expected, basically further increasing that differential gap between these two, that could see some downside for the pound Kiwi, and the exact same with the pound Aussie as well. What makes the pound Aussie possibly a little bit more attractive this week is that we also have the jobs data. So after the RBA showed us that we can't trust their communication last week with the just the shambles of the press conference that we have, the Aussie has obviously seen quite a lot of strength on the back of that. So if we were to see some really hot employment data for Australia, and at the same time we see a miss in UK data, that could potentially, see the markets wanting to retest all the way back down towards that 185.90. Let's just call it the 186 psychological level. That is possible if we see the data coming in with decent differentials, right? If UK data comes in really bad, Australian data comes in really good, that could be a really interesting one to look at. And then apart from that, we don't have any major Kiwi data this week, but same story. If the UK data comes in really bad, there could be some opportunities to look for some downside in the pound Kiwi as well. We've got key levels coming up to the downside, like that 228 psychological. Below that, we also have that series of support around the 227 level as well, just below that. So that could be in focus for the pound Kiwi and the pound Aussie. Now, what if the UK data comes in really, really good, right? So what if we see UK wages as well as inflation surprise to the upside? We would obviously expect some, that'll be the cleanest hawkish outcome for the pound. It will also suggest, that the labor market softness we've seen has not really been enough to cool domestic price pressures. So that is both a positive and a negative, but the markets will arguably read that as a positive. If both of these two things comes in hotter than expected, it'll just force the markets into potentially pricing in a premium towards 2 hikes this year instead of just the one priced in. So we're currently sitting at 16 basis points for November. So if the data is hot enough, it could see the markets fully pricing in a hike by November and starting to price a small premium for a possible second hike in December as well. It would need to be hot data for us to fully price in a second one, but just a small premium towards a second can already see some upside for sterling. Now, because the US calendar is so low or so light this week, and obviously because we have seen downside in the pound, I suppose pound dollar is the most attractive one to look at for possible opportunities if the data comes in really, really good. We've got that key overhead resistance around the 136.50, which will be a key one to watch for any major upside surprises. And if we're lucky, like if the markets are able to break and close above that, the next area to watch would be the highs all the way back up towards that 138.50 level. So there's a couple of key areas to watch to the upside for the pound dollar, and then a couple of key levels to watch at the downside for the pound Aussie and the pound Kiwi on that data. Now, apart from that, talking about the Aussie, let's then move on to the Aussie jobs data. Now, that is coming up on Thursday. Now, oh man, for those of you who watched the RBA last week, the RBA once again showed us that their communication skills are just horrible, right? Because they signaled one thing in the statement and then they said something completely different in their press conference. In their statement or in their monetary policy update, the bank signaled that they now think inflation will be able to cool without the need of an additional hike, right? Currently, the cash rate is sitting at 4.35%, and their policy statement last week, or their monetary policy report, showed that they basically priced out or no longer see the need for that additional hike that they saw back in May. Now, initially, that saw some downside for the Aussie dollar as we expected. But then came the press conference, and just like her predecessor, Governor Bullock managed to say something completely opposite in her press conference compared to what they signaled in their estimates. During the press conference, she was very hawkish. I mean, she said that, she said personally, she thinks that the bank should be hiking again. And then later on, she expanded on that, saying that the bank as a whole is basically just figuring out when will be a good time for them to hike again. Not like, oh, we're contemplating whether we should or shouldn't hike. The statement went from, we're not going to hike, to her saying she thinks they should hike, to then progressing to, oh, we basically, we think we're going to hike. We're just basically figuring out when the good or best time for that will be. So a very, very different press conference compared to what they said in their statement. And that saw a lot of strength coming into the Aussie dollar last week for the majority of the week. So that brings us to the labor data then. Remember, the previous labor data came in really hot. We had a super strong print at 76,000. The markets are seeing a bit of moderation now down to 15. But remember, the markets also expected moderation at the last print for June, and that came in really, really good. Now, after what happened with the RBA last week, after the repricing that we saw on the rate side as well, I mean, let me just show you guys here. For the RBA, the markets are back to pricing 14 basis points by the end of the year, and there's now about a 4 basis points price for that September meeting. So if we can see jobs data coming in really, really hot, I think that feeds into what the governor said last week. It feeds into the price action that we saw last week. And a strong print will arguably be the cleanest outcome for a possible Aussie trade if the data comes in really strong. Again, another strong employment increase, especially if we see the unemployment rate. Let's just go there. If we can see the unemployment rate ticking down as well to 4.3%, that would make it very hard for the RBA to continue arguing that the labor market pressures are fading, because that was what they said last week. If we see labor coming in much stronger than expected, potentially even upside in wages, that could see an extension to last week's move higher in the Aussie dollar, especially, like I said, if the unemployment rate can tick down. Now, like I mentioned already, I think the best case scenario there for a possible trade would be if the UK data comes in really bad, really soft. If the UK data is soft and the Aussie jobs data comes in strong, I would not be surprised to see the markets potentially making a run back down towards that 185.90, 186 psychological level. I think it's possible. Again, it might not happen all in 1 week, but if the data comes out perfectly, we could be on our way back down towards those lower levels. Again, that is just me personally talking. It's not a solicitation for you to have the same view or to take any trades. This is just the way that I'm looking at the markets and the way that I'm looking to potentially trade these events as well. Now, what if the data, for whatever reason, comes in exceptionally bad, right? What if we wipe out a lot of those prior gains that we have in the Aussie jobs numbers? What if we see a contraction? What if we see upside in the unemployment rate? I still like the Aussie Kiwi lower for the reasons that I've explained over the past couple of weeks. So I would still like for some downside opportunities there, targeting a move back down towards that 119 psychological. But after the RBA's comments last week, the data would have to be really bad for me to want to get into another trade for the Aussie Kiwi. But that's definitely an opportunity if the data is bad enough. Now, apart from that, we also have some flash PMI data coming up on Friday. Now, to be honest, guys, I'm not going to spend too much time on this one. For those who have traded flash PMI data before, you'll know that this is very much a differential play on the day. For example, if one country's data comes in really bad, we could potentially pair that currency with the country's data that comes out really good. So for example, if the Eurozone data comes in really good and the UK data comes in really bad, that could potentially see some upside opportunities in things like Euro Sterling, or vice versa. If Euro data is really bad, UK data really good, that could see some downside opportunities in the Euro Sterling. It's very much a differential play, but how we trade this will likely come down to what happens to the other data, like the UK inflation data and the jobs data throughout the week, especially when it comes to the pound. So I'm not going to spend too much time on that, but flash PMI data on Friday is definitely one to watch as well. Now, there's a couple of other events just to keep on the radar apart from the data. The FOMC minutes is coming up on Wednesday. Now, I've seen quite a few participants, talking about, oh, the minutes. Always remember that the minutes are backward-looking information, because the markets have already received a NFP print and another inflation report since we had the July meeting. So arguably, whatever the FOMC members thought at the July meeting, some of them might have already changed their mind, changed their view a little bit with the recent fall that we had in jobs and obviously the steady inflation data we had last week. So even if the minutes sound hawkish, the market should be able to look through that okay. But in case it doesn't, in case they don't, just keep that in mind as a potential risk coming up on Wednesday as well. The other risk we need to watch on Friday is option expiry. I've seen quite a few participants talking about the risk that option expiries could potentially pose for equities, mainly talking about concerns about gamma levels. So the idea is that as the expiry rolls over, it could potentially see some of that unwind, and that could eventually over the next week or two translate into softer price action for the S&P. Now, I'm not saying that because I think it's a good idea to short equities here. For those of you who know me by now, you'll know that I'm, I'm very bullish when it comes to US equities. Yes, we will have periods where US equities do really bad, and when we go into bear markets, I don't really see the conditions for those things develop or present at the moment, but there's always the risk of short-term downside. So I'm not saying, keep track of option expiry, because there's definitely downside risk. Also keep in mind that if lots of people are expecting something to happen, as they are, it might not happen at all. But just keep that in the back of your mind if you start seeing some weird price action playing out towards the end of the week, going into that option expiry on Friday. Now, apart from that, we also have earnings coming up. Very, very light earnings this week. We've got a couple of interesting names after retail sales data missed last week. I think things like Walmart could be interesting, Target could be interesting. So watch those things. Home Depot could be interesting as well. Again, purely based on the retail sales data we had on Friday. So watch those names. I mean, in terms of Home Depot, to be fair, it does have a close to 4% weighting in the Dow. So it's not small names, but it's obviously not those big tech names that we normally get a lot of volatility from. Now, apart from that, the other thing also just worth keeping on the radar is intervention risk. We are still trading close to that 160 psychological for the dollar yen. I don't think the story is over. We've spoken about this quite a lot in the last few weeks. Yes, the bounce have been quite aggressive. I do think these guys mean business this time with the US involvement. So just watch out for any potential intervention risks in the week ahead as well for the dollar yen. So with that said, quite a busy one. Like I said, not a lot that I'm too excited about, to be honest. but they can still create some volatility, so definitely worth just paying attention to those. As always, have a fantastic week, and any questions, don't hesitate to let me know.